to the India Development Debate, Tamanna, Inamdar, and the big story that we're tackling right on top of the show today is the decision by mutual fund company Franklin Templeton late last evening to close down 6 of its funds. The complete amount of money managed in these funds, or the AUM as it's called, is close to 30,000 crore rupees. The reason the mutual fund gave for closing down these funds was that the underlying assets of these funds, these were debt funds, the underlying assets were in a position where it seemed it would be difficult for any recovery. They were also facing a lot of redemption pressure and wanted to be fair to their unit holders so that some didn't redeem earlier while others continued to suffer. Well, understandably, the move has sent shock waves through the market to understand and grapple with what exactly happened. Several questions are, if the situation was so bad for a marquee player like Franklin Templeton, what about the others? Can there really be reassurances that this won't happen to any other fund or to your fund or to other funds of Franklin Templeton? Can a mutual fund company overnight just decide to suspend funds and create a situation where investors can't withdraw their own monies?
The coronavirus has claimed its first casualty in the mutual fund industry. Fund house Franklin Templeton is shutting 6 of its open-ended debt funds effective 23rd April. The funds getting wound down are low duration, ultra short-term income, credit risk, dynamic accrual, and income opportunities fund. All these funds essentially followed a high-risk, high-return credit risk strategy which turned unsustainable due to the uncertainty in this volatile market. Sanjay Sapre, the president of Franklin Templeton India, said that the liquidity in the bond market had dried up and hence servicing their debt was becoming difficult.
We believe it was the only way and very necessary to protect value for our investors and allow us to secure an orderly way to realize the assets in the portfolio. The COVID-19 pandemic and the related lockdown has resulted in significantly reduced liquidity in the Indian bond market for most debt securities and has also led to a significant increase, in fact I would say unprecedented levels of redemptions that we have seen.
The fund house was also getting a lot of redemption requests which increased the liquidity issues. Both debt and equity markets all over the world have collapsed after the COVID-19 was declared a pandemic. Companies saw a huge liquidity crunch as foreign investors kept selling their debt securities. This led to a huge sell-off in the debt markets, leading to a fall in prices and a rise in yields. And as economies get further impacted by the lockdown, investing in debt scripts got more risky.
But investors should not fret about the money that they have put in these funds. The fund house has said that they will be selling the underlying securities of these funds to pay back investors and unit holders in a staggered manner. So as and when the fund house gets the money from companies that they have invested in, they will also be redeeming the funds, or at least the part of the funds belonging to unit holders. However, until then, you will have to wait for the duration of the fund. That's essentially something called as the Macaulay's duration. So let's say, for example, the Franklin India Low Duration Fund has an effective duration of 1.2 years, which means the investor of the fund will have to wait for roughly 1 year and 70 days to get their money back. Another important point also to note is the fact that winding up of funds means that your SIPs and STPs as well will stop automatically. So you'll have to arrange for a fresh STP or an SIP if you are using one of these funds to transfer money into another equity fund. So essentially, to sum it up, as and when Franklin is able to realize portions of its portfolio, that's when unit holders as well will be able to get their money back.
Well, to answer all of these questions, I have with me today, first up on the show, Mr. Nilesh Shah, who's the chairman of AMFI and, of course, the MD of Kotak AMC as well. Mr. Shah, thank you so much for speaking with us on the show. I know you've had a long day answering several questions, but for the viewers of this program, for a larger group of viewers, I think it's important to give some clarifications. Number one, was there no other choice but to suddenly, abruptly, without notice, sort of shut down the gates on these 6 funds? What about people who may have wanted to withdraw?
Undoubtedly, I'm sure they would have taken all considerations to come to this conclusion that this is the best way forward. Obviously, they are in a far better position to answer this question. But I, on behalf of AMFI, would like to reassure investors that in the mutual fund industry today, more than 90% of AUM is in what is known as non-credit risk fund. When I say non-credit risk, it actually means lower credit risk fund. Over here, bulk of our investment is in treasury bills, government securities, certificate of deposits of banks, PSU bonds, AAA rated corporate debentures. This portfolio is absolutely liquid, is of superior credit quality as reflected in the ratings by independent rating agencies. And here markets are functioning absolutely normally. Even in that, about 5 to 10% of credit risk funds. There are different categories of credit risk fund. All credit risk fund does not have similar credit profile. There are different liquidity profile and credit profile. And clearly, for the conservative credit risk funds today, they are in a position to manage normal operations. Collectively, most of the mutual funds put together have zero borrowing today from the market. SEBI regulations permit us to borrow 20% of our AUM to meet redemption and dividend payouts. But as of today, information which we have received from majority of our members, none of them have any borrowing outstanding whatsoever. That means we are able to liquidate our portfolio to pay to investors. And we believe this isolated event at one fund company will have no impact on other mutual funds.
No, but technically, Nilesh ji, if I understand this, any mutual fund company can use the same trigger for any of its funds, like Franklin Templeton did late last night. Now, my question very simply is, and a lot of people are asking this question today, what is the guarantee that this can't happen again with another fund? In the COVID context, one doesn't know what's going to happen tomorrow. What is the guarantee that this can't happen again?
Absolutely valid question. And thank you for giving us an opportunity to explain. Today, if a fund company decides to shut down the fund, it comes at a grave reputation risk. The need to shut down a fund will happen only if you are not able to sell your portfolios. Now, across our equity portfolios, we have been able to regularly do buy and sell. And I joined this industry in 1997. Over 23 years, we have seen market shut down for a variety of reasons. We have gone through subprime crisis, taper tantrums, and yet every day we have been able to repay our investors. What we have done over the last 2-3 decades, we will be able to do tomorrow also. Then comes liquid fund and other low credit risk fund. Now here, the underlying market is reasonably liquid. Treasury bills can be sold, state development loans can be sold, certificate of deposits can be sold, PSU bonds can be sold. So if I get redemption, you can look at my portfolio to figure out I do have sufficient liquidity profile and sufficient credit quality to pay back to the investors. Keeping in mind individual credit profile and liquidity profile of the fund, any investor will be able to determine that majority of us don't have to do anything which has happened at one particular fund house. Their credit profile, their liquidity profile was different. They were borrowing money from the market. Our credit profile, our liquidity profile is superior, and our borrowing from the market is almost zero.
But Mr. Shah, most investors may not understand these technicalities. That is why they depend on fund managers. I know the terms and conditions would, on the face of it, legally allow this to happen. But the fact is that most investors may not understand all of this and go in on the advice perhaps of their financial planners or on the marquee name of the company, thinking that all will be well. My simple question is, at this point, why should the unit holder or the investor be left carrying the can completely? In the case of Franklin Templeton and some of these funds, the yields on the underlying assets may come in all the way up to 2030. So there is no guarantee right now about when the money will come, much of it will come back.
So Tamanna, your questions are very valid, and these are the doubts we have been answering throughout the day, not to ensure that our AUMs remain intact or our income remains intact. Our intention is to ensure that our customers' notional loss is not converted into real loss. If there is a panic rush on any financial institution and they have to liquidate everything to pay in one day, no institution can survive that. Which is why we are engaging in most transparent basis with our investors. Every mutual fund's entire portfolio is available to our investors. They themselves can look at our portfolio and determine, are they going to lose money from any of this portfolio's default? Answer is unlikely. Second, are these portfolios all such that they'll have to wait for 10, 15, 20, 30 years to receive money? Answer is no. In most mutual funds, almost 50% of the portfolio will be getting liquidated, self-liquidated over next maybe between 6 to 12 months. More importantly, when we go and invest long-dated papers, they are typically government securities and PSU bonds for which there is ready market. This is unprecedented time, and which is where RBI has taken number of steps to ensure that market functions normally. They conducted liquidity infusion through CRR cut, LTRO, and open market operation. They cut policy rates in reverse repo and repo rate. They ensured that credit flow remained to the needy sector of economy through TLTROs. And when the yield curve was not in shape, they conducted Operation Twist to sell short-term papers and buy long-term papers to rearrange the yield curve. Courtesy those steps, market has remained liquid. We are able to sell our papers and pay redemptions which are coming on a daily basis. We have repaid thousands of crore regularly over the last couple of weeks. And we don't see today any of our fund restricting redemptions or resorting to lockdown despite challenging situation, because our credit quality is superior, our liquidity profile is superior, and it's the question of confidence. If we can make the investors see our portfolio and understand our liquidity profile, I'm 100% confident that they will not look to redeem from mutual fund.
How has it been working from home, Nilesh?
It's a challenging scenario because you don't have any support system, and a lot of your data, even in this digital age, is physical in nature. You kept it in office. Your servers, while you can contact on a VPN, but there are some restrictions. Most importantly, you miss that human touch. It's a challenge, but by and large, people have worked really hard.
Yeah, no, undoubtedly. Even the whole financial institution system has really jumped to the challenge. We've not had any major hiccups. That is one story that isn't told as much. Fact is that we have managed it. The other part part is about the lockdown, and I saw the pun that you used there about other mutual funds locking down. My question now is, what kind of institutional support do we need to ensure that investors are protected? Or is it the case that it's time for investors to go back, relook at their investments very closely in mutual funds, figure out where their monies are being put, and actually then have a greater grip on the extent of risk that they are taking, and whether they have the same risk appetite as they may have had, say, 3 months ago?
So undoubtedly, we are seeing great support from regulator. I think we are making them work 24/7, including over the weekends and at odd hours. And I'm truly thankful to all the regulators who have kept their doors open and who have openly welcomed us at odd hours with our problems. In terms of investors, well, these are the most unprecedented time. This is medical crisis which requires medical solution, but markets, don't like uncertainty. They don't mind risk, but they don't like uncertainty. And when there is uncertainty around when lockdown will be lifted, when economic activity will resume normally, obviously market discounts it most negatively, which is reflected into today's prices. Tomorrow, if the actual lockdown and actual economic activity is better than what is priced by the market, markets will recover. If the actual economic lockdown and economic activity is worse than what is priced by the market, prices can fall. We don't know when lockdown will be lifted, when medical solution will emerge. Hence, my recommendation to investors will be a disciplined investor, maintain your asset allocation, keep something in fixed income, keep something in gold, keep something in equity, keep something in real estate. This disciplined asset allocation will help you overcome this uncertain phase. In 2008 as well as 2013, I've gone through this experience where prices had corrected all around. Investors' portfolio were wiped out, and people who took that short-term route where let me redeem from risk assets and move on to bank deposits or safe assets, they actually lost out when the upturn came. And upturn actually came much faster than what was anticipated by most people.
Well, we'll have to wait and see how things pan out over here. But it is a scary situation for investors. There's no doubt about it. Nilesh, Shah, they're trying to be the reassuring voice. I think we'll have to wait and watch and see how this turns out, what the regulator also says more clearly, and hope that this is limited to just these 6 funds, because if anything goes beyond that, it will really shake up confidence. Thank you so much, Nilesh, for speaking with us.
Thank you.